What would you say is the difference between investing and speculation?
I mean, this is a complex topic, and in if you study economics at a very high level, um, they look at kind of business cycles and and the way that they perform. Um, and so, there's a stage in a business cycle in which um, people make investments on the basis that the investment will return the principal invested to the investor together with um, interest thereon. So in other words, I'll make an I'll buy something, and that thing is going to generate income, ordinary income, operating income, at a rate that will allow me to get my money back, my principal back, and also give me a return. What happens in markets is that people lose a sense of focus on risk management, and they gain confidence in the market, and they begin to assume that market norms that currently exist will go on and on and on. And so, and this precise story happened post JDX NDX in Jamaica up until this moment. So the first order of business, people start making what I consider to be relatively good investments and not speculative. And then as they get comfortable, they start to make investments in which they know upfront that the investment will be able to give them back their interest, but might not be sufficient to give them back their principal. But they still get a return.
Mm.
And they feel good about it. So people start to do things where they're making an investment, well, maybe in a property, and the property is going to give them an income, and income is more than the interest expense, but they're not going to get their principal back. But as long as the party continues, they're cool.
Mm.
They kept doing that for a while, and they feel good about that. And then they get to a phase, which is what you asked about, which is the speculative phase. And in that phase, everybody who was born and started to do business in the time when people invested to get back their principal and the interest, they're all retired. The people who are investing just to get the interest only are okay. And then you have a generation of people who haven't really seen the tough old times, and they're speculators. And they invest knowing upfront that the income, that the thing that they've invested in, the operating income, is not going to be sufficient to generate enough money to cover the interest expense. And so they're going to pray that the underlying asset will be bought by somebody else for more than they paid for it. So they know that the business is not going to give them income stream sufficient, but they're going to assume that the kind of liquidity or market conditions or other people's interest or just raw hype is going to be sufficient to get somebody else taken off their hands at a higher price.
Mm.
And in that case, that investment is a speculative investment. And people who do that kind of investment know that they're not going to make enough money on the operation to cover their interest, but they can make themselves look whole by bringing to book up front their impression of what the market now values the thing at, which is higher than they paid for it,
Mm.
which is a fair value gain. It's some market assessment of the thing. And that's a speculative investment. And it's a normal cycle. It's not a Jamaican phenomenon.
Mm-hmm.
It's the way the world works. And anyway, the party, it always ends in tears. Somebody takes away the punch bowl, and everybody has to go home and start all over again. The investment cycle.
Mm-hmm.
Really good
Well,
explanation.
and
Real.
so, these things all exist simultaneously. So people pursue at all times different business models.
Yeah.
And, it's just a question of where the weight of the market is. We are by nature value investors, and so we don't do the speculative bit, but we don't condemn those who do, as long as they're transparent about their business model and people know that what they're doing is speculative investing.
Mm-hmm.